Morning, Thursday, August 6th. I'm Zach Howard, and here is my morning market update. We are going old school macro today, looking at the PMI data out of the US yesterday, and potentially giving us clues to where the macro regime is, was, and going. That matters because certain asset trades, asset classes, do better in different macro regimes. If growth and inflation are accelerating, reflation versus if growth is slowing, inflation is rising. On a relative basis rate change, that will be a stagflationary environment. So you have growth, but in real terms versus nominal, it's not really keeping up with the increase in the artificial money supply and the stimulus that is fiscal spending, and at times monetary assistance from the banks, the central banks, policy changes, etc. People don't really don't notice inflation when it's 2.5%, 3%. It's kind of the norm as the central bank policy sets out to rob you of that debasement each year annually, as part of their policy is 2%. But it's when it gets up above 3.5%, 4%, particularly that the main street people notice. Like bread used to cost $5, now it's $8, etc. We had oil prices in the 70s. Interest rates were in the teens. That was much more noticeable to see a stagflationary environment. The way the monetary system is structured today, we're never going to be able to have that type of spike in either, just because of the sheer massive number of what's out there in terms of monetary debt, etc., and just how much capital needs to continue to get rolled over annually. So stagflationary analysis, let's look at it from its economic growth. Like I say, we look at the PMI, the Purchasers Managers Index yesterday. Any numbers below 50 from a macro historical level considered slowing growth. You get in the low 40s, that would be like a recessionary level from a Keynesian economic standpoint. Above 50, rate of change is getting better, is still growing. So you look at like new orders, business activity, all this mechanisms of reading the data give us an idea where the traditional economy is going from a GDP standpoint, from unemployment, and prices paid. Rising prices sometimes would support growing economy, but also consumers are going to have to eat some of the policy stance in terms of tariffs. If the US is importing materials, goods, finished goods from other countries, and they're faced with a tariff, the suppliers and the sellers of those goods and services, they're not going to eat it. They're going to pass it along at higher prices. You can see that show up. So we're starting to see some of that yesterday in the PMI data. Global services, like when I look at the rate of change, this stuff getting better. So the services industry, we kind of look at the technology side of the economy and AI and innovations that's going to be broadening near to give us new measures of where economic growth will come from, as opposed to old school manufacturing. The US particularly is not built on the back of that anymore, but rate of change 52 to 55, that is a positive. Global composite S&P 500, S&P composite reading in the US yesterday, another positive rate of change. Non-manufacturing teetering on that 50 level, but still pretty resilient from where it was. Not a big change. This one stands out to me. Manufacturing prices, just talked about the tariffs and just debasement of the US dollar in real terms. You're going to see that show up in higher prices. The non-manufacturing employment level, that's a bit of a surprise. I got another slide here in a second to show you probably more keenness around that. New orders dropped off, but still above that growing positive territory, above 50, as I say. Risk factors, what to think about. Like I said, the non-unemployment part of non-manufacturing employment below 50. Talked about the selling prices. Those can give us weight as like potentially this is a stagflationary environment, but this is a look back. This is in July. We're already into August and really potentially projecting out into September and October. Really, that's where you want to look at when you're looking at macro, looking at investing, is where puck is going, not where it's been. Uh, Economic growth still looks really strong, even through these traditional metrics in the US. Uh, the doomers that were forecasting a recession over and over again have been completely wrong and will be completely wrong because they're not really understanding how the world works from the monetary system and how technology AI is really changing how we look at old school Keynesian economic metrics. They're not really as relevant today as they once were. So not full stagflation. And even if we were in a full stagflationary environment, there is certain asset classes that will outperform. Commodities, particularly, see that run up. Consumers going to get those higher prices. Businesses are going to pass along. If you're a business that has pricing power, you're going to do better in that kind of a stagflationary environment. Um, Technology, XLK ETF, those kind of instruments, high beta stocks that are like Microsoft, Nvidia, Google, they continue to show higher highs and continued uptrend. So those type of stocks do better in it. The US dollar is often not a great trade in a stagflationary environment. The reverse of that would be gold. It does pretty well, and thus gold miners to extent in a stagflation environment along with Bitcoin. But I don't think we're really in a stagflationary environment. We're probably teetering between reflation and stagflation. Both macro regimes are super healthy for an investment portfolio that's beta adjusted to that environment. Like I say, commodities, technology, uh, old school stuff, low beta, rates, fixed income, boring stuff, not so much. Consumer staples, that doesn't really work in this environment. Back to the non-manufacturing reading below 50 on the PMIs. What's that a result of? Technology companies or companies that can adapt technology to replace traditional workers through AI, through technology. They're going to grade or benefit than traditional companies, blue collar companies. They're going to have better margin expansion. Thus, as you can see here, the trend in the technology sector, particularly in that younger cohort, you don't need computer programmers. You don't need as many people in the technology side of your business because you can scale it with AI super agents to get way more productivity, get way more cash flow out of your business, which then opens up the idea, what do you do with the extra cash flow? You don't need to have 100,000 square foot warehouse anymore or office building particularly. You don't need to have a big, huge HR department. All the overhead comes with that. You don't need to have 25 VPs in your employee structure. So you have all this cost savings, more margin. You either buy back your stock, pay a dividend to your shareholders, or you maybe invest in newer asset classes like Bitcoin on the balance sheet. But that is going to be continually be the trend as companies that adapt get more efficient, get more cash flow, had to make more rational capital allocation decisions going forward. This is going to be a continued trend that gains momentum. You need to be paying attention to that. The corporate buybacks are a major tailwind for higher stock prices, major tailwind for higher equity prices, particularly in those mega cap stocks. July was actually a record buyback month when it should be traditionally one of the quietest months. Why is July the quietest month? Because most of the big buyback companies are in the corporate earnings blackout. They cannot buy their stock back till they post earnings, 1 to 2 days after they post their earnings. The financial sector, they're one of the biggest buybacks of their own stock because they don't have anything innovative to do with all their excess capital. Like they say, they are dinosaurs. They own all these massive buildings in New York and LA, particularly like JP Morgan, Wells Fargo, etc. So they buy back their stock each year to continue to help return on equity to shareholders through that mechanism. But even looking at Uber here today, it's out saying they are going to buy back their stock at $20 billion here in the coming quarter. They just reported good quarter as well. This is going to be a continued theme, a tailwind for the market for go higher, especially with these bigger cap stocks, is going to be buybacks rev up here now, August and July. This corporate window buybacks over. My notebook continues to say it's a bullish trend across markets, and you want to be taking advantage of buying the dips, zooming out and see what's there. Low volatility is continuing to trend into summer. Have a great day. We'll see you tomorrow.